The Federal Reserve has decided to hike U.S. rates to their highest level in a decade. The move is the Fed's first major decision under its new chairman, Jerome Powell. For more on the hike and the impact it could have, we are joined in the studio by our Lee Seung-jae. Good morning.
Good morning, Mark.
Good morning. So give us the details on this interest rate hike that leaves us now in this pre-financial crisis territory again.
That's right. Now, in the U.S. Central Bank's first major decision under the new Chairman Jerome Powell on Wednesday, just like you mentioned, the Federal Reserve hiked its key interest rate from 1.5% to 1.75%, which is the highest level since 2008. Now, it was the sixth rate increase since the Federal Open Market Committee began raising rates off near zero in December 2015. And of course, the move was widely expected as the U.S. economy continues to strengthen and Wall Street remains near record highs. But interestingly enough, the Dow did close on the red at the end of Wednesday, down 44.96 points or 0.18%. And of course, U.S. Fed Chairman Jerome Powell had this to say with the recent announcements.
The job market remains strong. The economy continues to expand. And inflation appears to be moving toward the FOMC's 2% longer run goal.
Now, in addition, 3 rate hikes are anticipated for this year, but the Fed will pick up pace even further in 2019. And now the Federal Reserve also significantly boosted its forecast for U.S. growth for 2018 and 2019, saying that the U.S. economy is on pace to expand 2.7% this year and 2.4% the following year. Now, the growth, according to Fed officials, will help lower the unemployment rate in the U.S. as well, as the jobless rate is expected to fall from 4.1% down to 3.8% this year and to 3.6% in 2019, which would actually be the lowest level since 1969, Mark.
Well, that's great news for Americans, and it seems the U.S. economy is finally picking up a head of steam after all these years of underperforming.
Right.
The big question we want to know, though, is the Fed's latest hike. It's going to have an impact on the South Korean economy. It's not going to be good for those of us in South Korea who own a home.
That's right. I mean, you're looking at a U.S. Fed rate going up 1.5% to 1.75%, which will make it higher than the South Koreans for the first time in more than 10 years. So we're looking at about 10 years and 7 months, roughly around. The Bank of Korea currently has the nation's benchmark interest rate at 1.5%. And of course, speaking on Wednesday at his confirmation hearing for a second term as BOK governor, Lee said the country could face serious problems if the gap between the two widens too much. Now, Lee added that if Korea raises rates to stay on par with the U.S., it could also cause major issues in a country where households are saddled with a record $1.3 trillion of household debt as of last year. But earlier this morning, he was a bit more optimistic, saying that the latest interest rate hike in the United States will actually have little impact on the South Korean market.
Okay, well, thank you very much for that, SJ. Your analysis today was very enlightening. And yes, when the Federal Reserve does anything, it shakes the world a little bit. And we'll see how this is going to affect South Korea in the months to come. But thank you very much for your report.
My pleasure, Mark.